The most viral claim in the silver world is also the easiest one to misunderstand. Bank of America is short 1 billion ounces of silver. If that's true, it's the kind of position that can break a bank, or break the market. If it's false, it's still dangerous because it teaches people to read derivatives data like a horoscope. So today we're doing the adult version of this conversation. No vibes, no slogans, just the plumbing, and we're doing it in the most important context possible. Silver has already ripped into the $90 zone in January 2026. That's when rumors turn into stampedes, and stampedes turn into bad decisions. Is Bank of America really short 1 billion ounces of silver? Quick disclaimer. This is not financial advice. I'm not telling you to buy or sell anything. This is market structure, public reporting, and risk logic. All right, let's build the case and then test it. Where the 1 billion ounces number comes from. The 1 billion ounces claim mostly traces back to the late analyst Ted Butler and a specific data set, the OCC's quarterly report on bank trading and derivatives activities. Inside those reports, the OCC shows notional amounts of derivatives by broad risk category. One of those categories is precious metals, and the tables list the top banks by notional amounts. Here's what that looks like in the OCC tables. Q3 2021 Bank of America, precious metals, notional, all maturities, was about $18,266 billion. Q1 2022, it was about $29,441 billion. Q3 2025, it was about $48,959 billion. Now watch the move people make. They treat that notional dollar value like it's a simple direct silver-only position, then they divide by the silver price at the time, and boom, hundreds of millions of ounces, maybe a billion. And if you're sitting there thinking, wait, global mine production is only around 830 million ounces a year. Yes, that's exactly why the claim went viral, because it sounds impossible. And markets love impossible, but sounds impossible is not evidence. It's just a hook. The first reality check. What would 1 billion ounces even mean? Let's define the monster before we chase it. 1 billion ounces of silver is a quantity. To translate quantity into exposure, you need price. At $25 per ounce, 1 billion ounces is $25 billion. At $50 per ounce, 1 billion ounces is $50 billion. At $90 per ounce, 1 billion ounces is $90 billion. That matters because the OCC number people point to is a notional dollar total inside a precious metals bucket. So ask a simple question. If Bank of America were net short 1 billion ounces at roughly $90, why would the notional bucket be around 49 billion? You'd expect something closer to $90 billion in silver exposure just to match the raw quantity claim, unless the notional number is not what people think it is, which brings us to the trap. The trap. Notional is not the net position. Here's the core problem. Notional value is not the same thing as net exposure. Notional is the reference amount used to calculate payments on derivative contracts. It's a measure of gross activity size, not a direct measurement of directional risk. Regulators have been yelling this for decades. In plain language, notional does not tell you short or long. It tells you how much contract face value is flowing through the pipes. A bank can have a gigantic notional number and still be close to flat. How? Because banks are dealers. They intermediate. They face one client on one side and hedge or offset on the other side. Gross goes up. Net can stay small. Picture two clients calling the same bank on the same morning. Client A wants price protection and buys 50 million ounces worth of upside. Client B wants price protection and sells 50 million ounces worth of upside. The bank stands in the middle and quotes both. Now the bank has activity on both sides. Notional adds both contracts. But the bank's net directional exposure can be near zero if it manages the book properly. So when you hear $50 billion notional, you should not hear $50 billion bet. You should hear $50 billion of contracts exist here, and we don't know the net from this table. Think of it like counting both teams' passes and claiming one team threw 1,000 yards against itself. That's not how it works. Another trick. Notional can be multiplied by structure. There's a second detail that almost nobody mentions. In some commodity derivative structures, the reported notional can be larger than the simple one-time purchase or sale that your brain imagines. For example, swaps can have multiple payment dates. Some reporting conventions treat a commodity contract's notional like quantity times price, times the number of remaining payments. So a contract that exchanges cash flows monthly for 3 years can show a notional that looks bigger than the underlying physical quantity you picture in your head. Again, that doesn't mean fraud. It means the data is not designed for TikTok math. The category is not silver. Next trap. The OCC category is precious metals, not silver. That can include gold, silver, platinum, and more. and there's a reporting change that matters for the timeline. Starting January 1st, 2022, gold derivatives began being treated as precious metals under the SACCR reporting approach rather than sitting in the exchange rate bucket that many people were used to. Meaning, the precious metals bucket can jump even if nothing changed in silver. So if someone points to a surge after 2021, you have to ask how much of that is actual new exposure, and how much is reclassification plus dealer flow. Okay, but show me the 1 billion ounce math. All right, let's do the exact math people are doing, but do it carefully and honestly. Take the Q3 2025 number, about $48.959 billion notional in precious metals. If you pretend for a moment that all of that notional is a pure silver position and you divide by a silver price, you can manufacture an ounce number. At $25 per ounce, 48.959 billion divided by 25 equals 1.95836 billion ounces. At $50 per ounce, 48.959 billion divided by 50 equals 979.18 million ounces. At $90 per ounce, 48.959 billion divided by 90 equals 543.988 million ounces. So yes, depending on what price you divide by, you can generate a number that looks like a billion ounces. But that is not proof of a naked short. It's proof that you can divide by prices and produce big, scary integers. Because the missing variable is direction. Notional does not tell you whether they are net short, net long, or hedged close to neutral. And the bucket does not even tell you whether the underlying is silver. So the 1 billion ounces number is not a direct observation. It is an inference layered on top of an inference. What does naked short even mean in this context? Let's clean up language because sloppy words create sloppy conclusions. A short can mean 1. A directional bet. You profit if price falls. 2. A hedge. You're short on paper because you're long somewhere else. 3. A dealer book. You're short to one counterparty and long to another. 4. A financing structure. You're short because you've lent metal and you're hedging the price risk while it's out on lease. A naked short is the scary version. Short exposure without a reliable offset, without inventory, without a borrow, without a hedge. Basically, a hole in the floor. In futures markets, naked is tricky language because clearing, margins, and offsets exist. So if you're going to accuse a major bank of a naked billion-ounce short, you need data that speaks to net exposure and risk, not just gross notional. What a bank is actually doing in metals derivatives. So what could that notional be in real life? Here are 3 common boring explanations that still generate gigantic notional totals. 1. Market making for clients. A mining company might hedge future production. A manufacturer might hedge input costs. A refiner might hedge inventory. Banks sit in the middle and quote both sides. That creates gross notional on both legs, sometimes across many maturities. 2. Leasing and metal financing. Silver leasing exists. If an industrial user leases metal, the bank may hedge price risk while the silver is out on lease. On paper, that can look short, but it can be paired with a physical claim, collateral, or a receivable. It is not automatically naked, and it is not automatically one way. 3. Custody and client-related hedging banks can act as custodians and service providers. A big derivatives total can reflect client hedging flows linked to physical metal held for others. Important, none of these explanations are a free pass. They just mean the OCC notional number alone cannot convict anyone. Why this rumor won't die. Now let's talk psychology, because if the data is so easy to misread, why does the story keep coming back? 2 reasons. First, people want a villain. A villain makes price pain feel meaningful. If silver dumps, it's not markets are messy, it's someone attacked us. Second, the number is emotionally perfect. 1 billion is a movie number. It feels like a final boss. And once you believe a final boss exists, every chart wick becomes proof. But markets don't run on movie logic. They run on balance sheets, collateral, netting, hedging, liquidity, and sometimes plain old crowd behavior. The 2025-2026 context, prices, panic, and liquidity. This rumor got oxygen again because the last 18 months have been violent. Silver surged and pushed above $90 per ounce in mid-January 2026. When price goes vertical, people assume someone is trapped. Then you get the second viral claim. Look, the Fed injected cash in repo. That must be a bailout for silver shorts. Here's the reality. Year-end funding markets can get tight for extremely standard reasons. Balance sheets are constrained. Quarter-end and year-end reporting changes behavior, and the standing repo facility exists specifically to prevent funding stress from spiraling. At the end of 2025, we saw record borrowing through that facility. That tells you liquidity was in demand. It does not automatically tell you silver shorts were saved. Could stress anywhere in the system spill into metals? Sure, but repo was used is not the same as silver conspiracy confirmed. What would a real 1B ounce short squeeze look like? Let's imagine the scary version for a second. Not to fearmonger, but to set a standard for evidence. If a major bank were net short 1 billion ounces and price was squeezing, you would expect to see rising margin demands and collateral pressure, forced buybacks into strength, dislocations between futures and physical, stressed funding conditions specific to the dealers most exposed, and a chain reaction across other positions as they sell what they can to cover what they must. In other words, signatures, not rumors. Signatures. And if those signatures appear, you won't need a meme to recognize them. You'll see them in spreads, curves, delivery behavior, and risk disclosures. How to actually test this step by step. So what's the correct way to handle the 1 billion ounces story as a serious analyst? Test 1. Track the OCC series over time. If precious metals notional is rising, falling, or stable, that tells you something about activity, but it is a smoke detector, not a courtroom verdict. Test 2. Look for net clues, not gross totals. Notional is gross. What you really want is net exposure, or at least proxies for it: fair value, netting, collateral, and changes in risk disclosures. Those are harder to meme, and that's why they matter. Test 3. Pair it with CFTC positioning. The KOT reports show categories like swap dealers and producers, merchants. If banks were truly trapped and forced to add shorts into a rally, you'd expect certain patterns. Not perfect, not instant, but you can look for stress fingerprints. Test 4. Follow physical signals. If physical gets tight, you see it in things like backwardation, persistent premiums, delivery dynamics, inventory drawdowns, and industrial substitution or delay. Those are harder to fake than a screenshot of a notional table. Test 5. Ask the simplest question: what would it take for the rumor to be true? Answer: you would need data that ties the bank's book to a net, silver-specific directional short of that scale, not just big notional in a broad bucket. How to read the OCC table without fooling yourself. Let me slow this down and show you what the OCC table is actually saying. First, the numbers are notional amounts, typically shown in millions of dollars. Second, they're broken out by maturity buckets, 1 year or less, 1 to 5 years, and more than 5 years. Then the OCC adds it up as all maturities. So when you see $48,959 next to Bank of America, that's not $48,000. That's $48,959 million in notional. Now here's the key dealer point. Banks often show up with huge totals because they're intermediaries. When a bank stands in the middle of two trades, both sides can appear in gross notional reporting. So the table is really saying, this institution is a major dealer in this category. It is not saying, this institution is making a one-way bet. Why options make the ounce math even worse. The divide notional by price trick gets even shakier once options enter the room. With options, notional often reflects the full underlying amount the option references, even though the option's risk is driven by delta, gamma, and volatility, not just a simple one-to-one exposure. Example, a client buys call options on silver. The bank is on the other side. On paper, that can look like the bank is short silver exposure. But the bank can hedge that exposure dynamically by buying futures or physical as delta changes. That hedging activity creates more gross flows and more gross notional. The point is, options can manufacture massive-looking notional totals without implying a massive naked short. So if someone tells you, look at the notional, that's the size of the short, ask them one question. Are you sure you're not just looking at the size of the dealer book? What data would settle this argument fast? If I had a magic wand, I'd want 3 things. 1. Net exposure, not gross notional, the difference between how much contract face value exists and how much directional risk exists. 2. Silver-specific breakdown, not precious metals, not a blended bucket, specifically silver, and how much of it is swaps, how much is options, how much is forwards. 3. Stress evidence. If a bank is trapped, you don't just see a big number. You see defensive behavior, sudden risk reduction, unusual hedging costs, shrinking liquidity, and visible dislocations. We don't get that full picture from one OCC table. So the responsible conclusion is not case closed. The responsible conclusion is interesting signal, incomplete evidence. DIY check how you can verify the numbers yourself. If you want to do this like a pro and not like a rumor account, go straight to the source. The OCC posts each quarterly report, and it also posts an XML file that can be opened in Excel that lets you pull the table values directly, quarter by quarter, without relying on screenshots. Build a simple timeline. precious metals notional for the top banks each quarter, then compare it with what happened in the silver price. You'll immediately see why notional up does not automatically mean short squeezed. Sometimes it's just more client flow, sometimes it's a reporting shift, sometimes it's a mix of both. Why Ted Butler's frame mattered, even if the math gets abused. Now, to be fair, the reason analysts like Ted Butler focused on banks at all is because silver is a small market. When a small market is dominated by large dealers, concentration matters. A concentrated position can move price, even if the position is legal and even if it's hedged. So the real value of the Butler-style work is not the exact ounce number. It's the warning. Don't ignore dealer concentration just because the reporting is messy. But the danger is when people turn that warning into a single magic number and stop thinking. The supply comparison that people get right and wrong. When people say 1 billion ounces is more than a year of mine production, they're pointing at something real. Silver supply is finite, and annual mine output is not huge. But here's where the logic can go sideways. Derivatives are not a warehouse inventory list. They are contracts referencing price. The notional total can exceed annual supply many times over because multiple participants are hedging the same future cash flows in different ways. That's exactly why notional is not automatically a physical claim. So yes, the comparison is emotionally powerful, but it doesn't by itself prove that a bank owes the world 1 billion ounces of metal tomorrow morning. What I'm watching as the story evolves. Because we're in the $90 zone, the market is hypersensitive. So here's the disciplined way to watch this narrative without getting trapped by it. Do we see persistent physical tightness signals, not just one-day headlines? Do we see unusual stress in spreads and funding, not just repo existed tweets? Do we see dealers reducing risk into rallies or getting forced to chase price higher? Do we see the OCC precious metals line trend higher while risk proxies trend worse? That's how you move from rumor to evidence. You don't declare victory from one table. You build a dashboard and let the market confess in its own language. Here's the honest answer. Public OCC data shows Bank of America has had very large notional derivatives in the precious metals category. But notional is gross activity, not a direct measurement of a net short position. And the category itself is broader than silver, with reporting changes that can inflate the bucket. So does Bank of America have metals exposure? Yes. Does the OCC table prove they are short 1 billion ounces of silver? No, not by itself. The 1 billion ounces story is a hypothesis built from a conversion that ignores direction, netting, structure, and the underlying mix. That doesn't mean there's no risk in the system. It means you need better evidence before you call it a smoking gun. Here's what I want you to do next. 1. Stop treating notional as proof. 2. Track the OCC precious metals line like a heartbeat monitor. 3. Pair it with positioning and physical tightness indicators. 4. And most of all, don't let a big number replace real analysis.